Good afternoon. Ito po yung kadugsong po ni Kim Maxwell Bayer na report. Long run profit maximization. A monopolistically competitive corporation experiences zero economic profits over the long run. A company examines its cost of manufacturing before adjusting its price to make a justifiable profit. In the event that firm A overcharges rival firm B will profit from the situation by undercharging. The profit maximization can be as a process in the long run or a short run to identify the most efficient manner to increase profits. According to conventional economists, profit maximization is the only objective of organizations, making it as the base of conventional theories. It is also regarded as the most reasonable and productive business objective of an organization. For profit maximization, two conditions must be fulfilled, namely, the first order condition. The first order condition, under first order condition, makikita nyo po yung marginal revenue. Marginal revenue can be defined as the revenue generated from sale of the last unit of output. On the other hand, marginal cost can be described as the cost incurred in the production of one additional unit of output. Both TR and TC function involve a common variable which is output level Q. Makikita nyo po, level Q. The first order condition states that the first derivative of profit must be equal 0. The second order condition, it requires that the first order condition must be satisfied in the case of decreasing MR and rising MC. As mentioned, profit maximization happens both in the short run as well as long run. Long run can be described as the time period in which all the inputs are variable. Similar to profit maximizations in the short run, organizations maximize profits under perfect competition and imperfect competition. Next, long run competitive equilibrium. A company reaches equilibrium over the long term when it modifies one or more of its plans to create output at the least point on the long-run average cost curve. The demand curve determined by market pricing and this curve are tangential. In the long run, a company simply makes standard profits. The industry will draw new firms into it. A firm has above average short-term earning. Competitive equilibrium is a condition in which profit maximizing producers and utility maximizing consumers in competitive markets with freely determine prices arrive at an equilibrium price. At this equilibrium price, the quantity supplied is equal to the quantity demanded. In the other words, all parties, buyers and sellers, are satisfied that they are getting a fair deal. Competitive equilibrium is achieved when profit-maximizing producers and utility-maximizing consumers settle on a price that suits all parties. At this equilibrium price, the quantity supplied by producers is equal to the quantity demanded by consumers. The theory serves many purposes, including as an analytical tool and benchmark for efficiency in economics. Next, economic rent. Amounts earned that are in excess of what is required economically or socially are referred to as economic rent. This may happen, for instance, when a buyer makes an offer before learning the seller's suggested price in order to obtain an exclusive goods or service. Economic rent thus rises as a result of market defects. If markets were perfect, prices would fall due to price competition, so economic rent would not exist. Economic rent is Economic rent is an amount of money earned that exceed that which is economically or socially necessary. Market inefficiencies or information asymmetries are usually responsible for creating economic rent. Generally, economic rent is considered unearned. Economic rent can appear in several contexts, including labor markets, real estate, and monopolies. Understanding economic rent should not be confused with normal profit or surplus that arises in the course of competitive capitalist production. This term also differs from the traditional use of the word rent, which applies to payments received in exchange for the temporary use of a particular good or property, such as land or housing. Economic rent and labor. In this regard, unearned income refers to the amount offered that is above what the employer felt that their skill and abilities were worth in the current marketplace. It can also apply when a person's skill would be valued less in an open market, but they receive more due to an affiliation with a group such as a union that sets minimum standards of pay. Then, economic rent and facilities. It can also refer to a situation, in which two properties exist with the exact same features except for location. If one location is preferable to another, then the owner of preferred location receives a higher payment than the other without having to complete any additional work. The lack of additional labor on the part of the owner can also be considered unearned income. Other economic rent forms. Other forms of economic rent include information asymmetries, in which an agent derives excess profits from having information not provided to the principal of the rest of the market, like a contract rent. It refers to a situation wherein there is a mutually agreed upon deal between two parties, but external conditions change over time, granting one party in unequal benefits, usually at the expense of the other party. Then, monopoly rent. It refers to the situation in which a monopoly producer lacks competition and thus can sell its goods and services at a price far from above what the otherwise competitive market price would be at the expense of consumers. And the last is differential rent. Differential rent refers to the excess profit that may arise owing to differences in the fertility of the land. The surplus that arises due to the difference between marginal land and intramarginal land is the differential rent. It is generally accrued under conditions of extensive land cultivation. And the next is producer surplus in short run. The surplus of producers is only surplus due to the fact that the amount producers earn through market exchange exceeds the minimum amount they need to supply any quantity of an item in the near term. Producers experience a net advantage or supplies in the short term. Excess profit disappears completely in fair competition and monopolistic competition due to free entry. Next is constant cost industry. The average cost curve and marginal cost curve of a typical representative firm are shown in the constant cost industry graph below. As shown, this curve intersect at an output level of Q and a price of P, given the state of the market at the time. This firm's pricing and output combination maximize profit. At first glance, it might seem that a constant cost industry is nothing more than an abstract possibility and quite removed from reality. This is because we are taught that supply curves are upward sloping and that any increase of output must come with higher costs and prices. This is true in most cases. However, the idea behind the constant cost industry is one of the long-term adaptation. The supply curve that we are most familiar with is a short-run supply curve that exists within a time frame that does not allow firms to expand production by building new plants and equipments and only squeezing more production from existing facilities. Now, what happens if for some reason there is an increase in market demand for the product that this firm supplies? For example, suppose that the market under examinations is the market for home treadmills at the initial level of demand. The market is stable, but then a new body of research is made public that conclusive proves that jogging on treadmills 3 times per week will extend lifespan by 20 years. Next. Increasing cost industry. The increasing cost industry refers to the industry in which production costs rise as the market expands. We know the cost of production is affected by the increased production of existing businesses or by the entry of new one. In the long run, the cost of production either increases or decreases depending on this industry. The industry is which the cost of production increases with the expansion of the market is known as the increasing cost industry. The supply curve of the increasing cost industry is upward sloping. We have example of an increasing cost industry are petrochemical industries and coal mining industries. For example, petrochemical industry. Assume you own a petrochemical production plant and demand for your petroleum products dramatically increases. What would you do? In such a scenario, you will most likely boost your output to enhance your profits. Based on your profits, several other companies will be encouraged to begin petroleum production. Will they, however, be able to make a comparable profit? Or with their presence, will you able to earn your existing profits? Turns out the answer will depend on whether this is a constant, decreasing, or increasing cost industry. Next. Decreasing cost industry. Decreasing cost industry is one in which the cost of an item declines as its production increases. The phenomenon is referred to as a downward sloping long-run supply. This is caused by the growth of an industry which typically result in more competitors, less demand, and lower perceived value of the product. Depending on the nature of the business, decreasing cost industry can either cause the decline of a company or simply be a part of its natural evolution. In some cases, decreasing industry happen because an increase in production does not significantly affect the cost of producing the product. This is common with knowledge-based products such as software. It can also be a factor in the production of items which can be significantly improved with greater efficiency. Once the company has learned how to maximize its effort, it can increase its customer base by lower prices. Decreasing cost industry may also be the result of the company's decreasing cost of doing business. Next, the effect of taxes on the most mobile factors in the economy, such as capital, cause the most distortions and have the most negative impact. Taxes are on factors that can't easily be moved, such as land, are the most stable and least distortive. Like this, most harmful in on your what you earn, taxes on what you earn, like corporate income tax. Corporate income tax are taxes on business profits earned by C corporations. The corporate income tax directly increases the cost of making investment in capital, like machinery and equipment, which businesses and workers use to be more productive. Then, individual income taxes. Individual income taxes are applied to wages and salaries, business income from pass-through businesses like a sole proprietorships and LLCs, and investment income. Um, then payroll taxes. Payroll taxes are paid on the wage and salary of employees to finance social insurance program like Social Security, Medicare, and unemployment insurance. Payroll taxes apply only to labor income and not to business income like the previous two forms of tax. Then, tax on what you buy, like gross receipts taxes, are applied to a company's gross sales without allowing any deduction for cost. Unlike sales taxes or value-added taxes, VAT, tinatawag nating VAT, gross receipts taxes are applied to business transactions and final consumers purchases. Then, excise taxes are imposed on a specific good or activity such as cigarettes, alcohols, and fuel. For example, a tax on cigarettes to discourage smoking. However, this distortion makes excise taxes an inefficient source of revenue. Then, sales taxes are imposed on retail sales of goods and services. Ideally, sales taxes are imposed on all final retail sales of goods and services, but not on intermediate business-to-business transactions in the production chain, as in the case of gross receipt taxes. The next is taxes on what you own, like wealth taxes. Wealth taxes are imposed annually on individuals' net wealth. Net wealth is calculated by the market value of their total owned assets. The price those assets would get if sold, and subtracting their liabilities, everything that persons owes, including loan, mortgages, and other debts, like that. Then, estate taxes are levied on the value of property that is transferred to the heirs upon the death of the original owner and can be thought of as a one-time wealth tax. Then, property taxes. Property taxes can be levied on immovable or real property like land and buildings, and personal properties like cars, machinery, office equipment, etc. Because personal property is much more mobile and thus more sensitive to taxation, personal property taxes distort investment decisions, complicate business tax compliance, and reduce economic growth. Next is long-run elasticity of supply. This is the last one of my report. Long-run elasticity of supplies. It is based on the law of supply, which states that the number of goods and services supplied will usually change when prices change. It also measured how much the quantity supplied of a good or service changes when there is a price change. But since supply and demand are more elastic in the long run movements in prices are more muted, and quantity adjusts for more easily. The elasticity of supply or demands can vary based on the length of time you care about. In the market for goods and service, quantity supplied and quantity demanded are often relatively slow to react to changes in price in the short run, but they react more substantially in the long run. And, 。 Some companies are more sensitive toward price changes in terms of the quantity they produce, whereas other companies are not as sensitive. A price change can cause companies to increase or decrease the number of goods they supply. The elasticity of supply measures the response of firms to price changes. Um, The ability of suppliers to alter the quantity of a good they produce directly impact the degree to which the quantity supplied can change in response to change of price. Think about a construction company that builds houses. When there is a sudden increase in the housing price, the number of homes built does not increase as much. That's because construction companies need to hire additional workers and invest in more capital, making it harder to respond to the price increase. Although the construction companies can't start building a significant number of houses in response to the price increase in the short run, in the long run, constructing houses is more flexible. The company can invest in more capital, employ more labor, etc. Time has a strong influence on the elasticity of supply. In the long run, the supply of good or service is more elastic than in the short run. And that's all. Thank you.